Welcome to this week's edition of Trade the Trend, a weekly video about where the stock market is heading. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as gold, copper and uranium in a separate video. I'll leave a link for that in the description section below. I'm also going to show you what a major international market is pointing towards, so make sure you stick around for that. As always, this is general commentary. It doesn't take your personal position into account. With all of that said, let's get into the first chart. So I'm going to start with the SP 500, and it really has been a lot going on in this chart over the last couple of weeks. So the bullish scenario, I think, is really getting stretched. What we have this week is prices turning lower from declining moving averages. So I've got the 50 and the 100-day moving averages on this chart. The averages haven't crossed yet, so technically they still remain in an upward position, but they are declining and they're moving closer to the crossover point. So that's a concerning development when you have that moving average structure and you have price bouncing lower off those declining averages. So I think the technical picture is weakening as it currently stands. We've got this upward trend channel which has been in place since the lows last October. It's really being tested now as well, and I think the key to this whole thing though remains this big support band at 4,200. It's been a technically active region since coming all the way over here to January 2022. So coming up to 2 years, not quite there yet, but it's been a really important technical area. Firstly, as a resistance point, or really firstly as a support point, as the market declined in 2022. Then it became resistance, and now we're going to see how significant it is with the market in this quite a vulnerable position which it presently is at. I think during the week, I actually did consider lightening my S&P 500 exposure. So if you've been watching these videos for a while, you'll remember that, well, you may remember, I established a long position after this reversal day we had after a key CPI number back in October last year. And I've held that position the whole way up to present day. I added to my position when the market broke higher in around May, and so this week was one of those points where I thought, look, should I pare back that position? Should I reduce it? And in the end, I decided not to. My thinking is that 4,200, that's the level. That's what I'm watching. It's been tempting to turn down the dial on my position, but I've kept it in place for a little bit longer. I think when I look at this chart, this S&P 500 chart on its own, it still remains reasonable. It's not a badly structured chart by any means. We do have momentum from the low, and this pullback we've had still retains the proportions of a potential correction, and also that follows through when I look at the Nasdaq. When I look at the Nasdaq, we've had the strong rally. We've had what still looks like a sideways consolidation in a bullish flagging formation. When I look at those two charts, and I look at them on their own, I look and I think, well, that doesn't look so bad. That actually looks encouraging. But what is bothering me is that it's that the market breadth continues to deteriorate, and for me, that's the biggest concern. So I'll show you what I mean. We haven't spoken about the S&P 500 equal weight ETF for a while, but it's worth having a look at now. So what we've got here is, well, it's been in decline since July, and it was never able to break above its February high. And what we've had in the last few weeks is that the moving averages have crossed. They've clearly turned to the downside, and what's happened in the last week is we've had a fairly shallow rally back towards the averages, hasn't been able to get back to them completely, and now we're seeing this sell off again. So that's a concern. It's it's hard to see upside in the SP 500 and the Nasdaq with this broader indicator of market strength selling off and that path of least resistance appearing to be to the downside. We can get some support if we look along here. You can see these previous low points over the last year or so, and if you project them across, we're kind of getting around a point where we could see support. This could still find support around 137.50-ish, thereabouts. We've got some levels to keep an eye on, but the undertones are weak. We have a declining market below declining moving averages and having shallow bounces. It's not a recipe for a market which looks about to do something amazing to the upside. And also my concerns come from looking around the European markets. And so this is the Euro Stoxx 50, so the biggest 50 stocks in Europe. And we've got a double top. So we've got a double top when you compress the chart a bit. Just look at the structure. We had the big run off the March 2020 low. We've now got a double top in place. Now, a double top doesn't mean it has to be a giant reversal. It can be a pause before markets break higher, but nonetheless, it is a topping pattern of note. Of more concern for me is the moving averages. The moving averages have crossed; they've turned lower. Prices now trading sideways below the moving average. We've had a shallow bounce off the low from 2-3 weeks ago. Just got to the averages, started to turn lower again. So it's in a structurally vulnerable position. When markets are beneath moving averages, they become vulnerable. You can see what happened last time. The market was below moving averages. Not to say that same decline happens again, but that's a vulnerability. That's a risk when we have this setup. It's one to take seriously, one to be aware of, and one to take into consideration when positioning a portfolio. And that's really the way I'm playing this. If you've been watching these videos for a while, you know I've made a case of being cautiously long over the last 12 months. It's been that case of being cautiously long, and I'm still positioned that way myself. But the puzzle pieces, as I'm seeing them, they're just becoming increasingly mixed, and so my cautiously long approach is becoming even more cautious in its makeup. I'm selling stocks that are hitting exit stops, and I'm not in a hurry to replace them. So there's a higher cash component to what I'm doing. There are a couple of other things I want to show you before we wrap up, which are important. But first of all, if you're getting some value from this, please hit that like button. Please leave a short comment. Just tells YouTube you're watching, you're engaging. YouTube shows other people, so that helps heaps. So please do those things, and hit that subscribe button if you haven't already done so. Now, just moving along to a couple more things. Russell 2000. So this is a percentage of Russell 2000 stocks above their 200-day moving average, and this comes back to that whole breadth situation I've been speaking about. Just looking at this in the last couple of days, it's breaking lower. So the number of stocks above their 200-day moving average is breaking lower. It's hit a new low point of 25. So that's the lowest point since coming across here to October last year. And this trend remains down. It had a shallow bounce. So again, a shallow bounce. When you have an impulsive move followed by a shallow reaction, it's often a sign that you're going to see more follow through on the other way. And in this case, it's to the downside. So that remains that path of least resistance that I speak about. And so that worries me. And I think the Russell remains the weakest link in this as far as the US markets are set up at any rate. Just quickly looking at the Russell itself, this is where we find ourselves. The big trading range we've known about for a long time, just zeroing in on the recent price action, declining moving averages, market breaking down from a shallow after a shallow bounce right at the bottom of this support band that stretches back to the beginning of the year. We still have the thing. it's important to remember we are still within the range. We haven't broken down. The Russell hasn't broken down from the range, but it's in a structurally weak and vulnerable position. So I don't think this is a sell any moment. That's not what I'm saying. What I'm saying is that I think this is a time for extra caution. I said that last week. I said last week that this was a time for extra caution. That very much remains the case. As I say, I don't think it's a sell everything moment, but I'm still holding stocks. So I'm still holding stocks in my own portfolio that are in uptrends or consolidating within uptrends, but I'm also looking to shut down risk with stocks that aren't performing, because this just remains a great concern, I think, for the overall market. And we've got that 4,200 level to keep an eye on. And I'm not in a hurry to buy. I'm not in a hurry to buy this dip. I want to buy dips when the market is pulling back to rising moving averages, not when it's reacting downwards from declining averages. One last thing I want to show you, this US 10-year bond yield, really interesting. It's hit 5%, or I think it's hit 5%, and which is big resistance area. Just quickly on the weekly chart, just refreshing ourselves on what 5% means. And so going back to 1993, you can see 5% has been a big technically active region, big run up into it, and here we are now testing it. What I find interesting is when I look at this, we've actually got some divergence when we look at the RSI. So look at that. You've got the new high there in yield. Look at the RSI, and you don't get the new high in the RSI. So we don't have confirmation on the RSI to that new high in the yield. That doesn't tell us that a top's in place, because the market can keep rising and the RSI can catch up and the divergence eventually disappears. But it is interesting. There've been a lot of people trying to pick the high in yield this whole way up, and I think they continue to do so. So that's probably a reason that maybe it won't be a high in yield. But nonetheless, divergence is worth being aware of. You can see we had divergence back here in where was it, last year, September, November. The RSI didn't make a new high where the yield did, and it turned into a period of decline. And also there was one more period reasonably recently that I saw on here. Where are we? We've got that one, and we've got, there's a period in here going back into 21 where the bond yields continues up, but the RSI doesn't confirm it. And then again, that leads to a period of decline. So look, these RSI points are worth keeping an eye on. If we do get some relief in yield, maybe that can underpin the market somewhat. We can get more of a rebound. But until that happens, I think it's just a case of buttoning down that risk, being a bit conservative, and protecting your capital. Protecting capital is always the key in these situations. So look, thank you for joining me. Been fun talking to you as always. I look forward to coming back talking to you next week. Till then, bye for now.